Hi, I'm Viram from Vested, and today we're going to be talking about an interesting tool called stock splits that companies use to manage their stock prices. In this video, we will discuss how stock splits and reverse stock splits work, how they are executed, and what are the reasons why companies use stock splits as tools. We will also briefly discuss how Apple and Tesla use these splits to manage their stock prices. And finally, we'll cover how you as an investor are impacted by these stock splits. So firstly, what exactly is a stock split? All publicly traded companies have a set number of shares that are being traded in the market. When a company is concerned that its share price is too high or too low, it can opt for stock splits to manage the prices. There are two tools that a company uses to manage the share prices. The first is a normal stock split, and the second is a reverse stock split. A stock split can help a company lower its share price to appeal to new investors, while a reverse stock split can actually boost the company's share price and help preserve its listing on a major stock exchange. Interesting, right? So now let's see how both of these tools work. First, let's look at normal stock splits. In order to make the company's shares seem more affordable to small investors, the company would do two things, which is part of the stock split. First, it decides to increase the number of shares that are outstanding by issuing more shares to current shareholders. But this would affect valuation, right? So this brings us to the second thing that the company does, is that as the number of shares are increased, naturally the price is manually reduced at the same time. So this means that the company's valuation or market cap remain unchanged while the number of shares increase and the prices decrease. Stock splits are executed in ratios. So a 2-for-1 stock split, for example, grants you 2 shares for every 1 share of the company that you own. Say you have 1 share of a company's stock. If the company opts for a 2-for-1 stock split, the company would grant you an additional share, but each share would be valued at half of the original. So after the split, your 2 shares would actually be worth the same 1 share that you owned starting with. Now, let's look at the other tool that companies have, which is reverse stock split. A reverse stock split reduces a company's number of shares outstanding. So if you owned 10 shares of a stock in a company, for example, and the board announced a 2-for-1 reverse stock split, you'd end up with 5 shares of stock. The total value of shares still remains the same. So if the 10 shares were valued at, let's say, $4 per share before the split, the 5 shares would be valued at $8 per share after the split. In either case, the value of your investment remains 40, but now you just own lesser number of shares versus earlier. Now, why do companies engage in stock splits at all, right? So reason number 1 is to increase or decrease the liquidity of a stock. When a company's share price increases to levels that are too high or are beyond levels of similar companies in their sector, they may decide to do a stock split. The reason for this is that a split can make the shares seem much more affordable to smaller investors, and this has the practical effect of increasing the liquidity in that particular stock. On the other hand, when the price of a stock drops too far, the company may lose its place on a stock exchange. How does that happen? Well, the New York Stock Exchange, for example, has regulated limits for the price of stocks. The minimum price should be $1, and if the listed stock closes the trading day beyond $1 for 30 consecutive days, it's actually a candidate for delisting or removal from the New York Stock Exchange. To avoid this, the company uses a reverse stock split to consolidate shares in a way that results in a higher per share price, so that the company can still remain listed on the exchange. So another reason why a company might opt for a stock split is to try and increase the share price of the company. When a stock undergoes a split, there is an immediate decrease in its stock price, but there actually could be an increase later, primarily because small investors may perceive the stock as a lot more affordable and go and buy into the stock more and more. This effectively boosts demand and drives the prices up. Another possible reason for the stock price to increase is that the stock split provides a signal to the market that the company's share price has been increasing. People may assume that this growth will continue in the future, and this further lifts demand and prices for the company. So this happened actually in Tesla's case. In August 2020, Tesla announced a 5-for-1 stock split. Just after the split, Tesla's shares were priced at about 418 per share. 4 months after the split, they fetched more than 625 per share, almost a 50% increase. As of this video's recording, Tesla's stocks have touched $780 per share. Next, let's also look at another large company's case study, which is Apple. So in June 2014, Apple split its shares 7-for-1 in order to make its shares more accessible to a larger number of investors. Right before the split, each share's opening price was approximately $649. And after the split, the price per share on market open was $92. Existing shareholders were given 6 additional shares for each share they owned prior to the stock split. So an investor who owned 1,000 shares of Apple before the split now had 7,000 shares of Apple after the split. Apple's outstanding shares increased from 861 million to about 6 billion. However, as we discussed earlier, the market cap of the company remained largely unchanged immediately after the split. It was close to 556 billion. The day after the split though, the price increased to a high of $95, reflecting the increased demand because of the lower stock price. So lastly, let's look at how stock splits affect you as an investor. If you already hold a company's shares, it wouldn't really affect you because the underlying value of your investment is still the same. But if you aren't a shareholder currently, a stock split could motivate you to buy. As discussed earlier, the ability for more people to buy a stock can bump up the share price of a company, which in turn might actually increase its market cap. Also, the share price becomes much more affordable, right? Alright, so that's it for today. What we learned was how stock splits work, what are stock splits, what are reverse stock splits, and how Apple and Tesla use them to manage stock prices. Let us know in the comments if you have come across any other companies who've utilized the stock split to manage their share prices, and if there are any other interesting case studies for us. Thanks for watching. If you like our content, subscribe to our channel and hit the bell icon to get regular updates.